Hello, my fellow investors, and welcome back to another fundamental analysis video. Today, guys, we're going to take a look at the company Eli Lilly, which had earnings as of today, actually. And I want to take a look at this because, wow, it's been a while since I've covered them. I don't think I've ever covered them, and if I have, it's been a while. So when I cover the fundamentals, their earnings, and then I just kind of free cash flow to see if at the whopping price, which I didn't even think it was real, is this a good price to buy this company at? But before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Unveiled Investing. If you'd like to join us on the Discord, the link is in the description below. So with that said, let's get started with this analysis. So before we actually head on to their earnings summary, understand, guys, that when it comes to pharmaceutical companies, you really should check out their pipeline, right? It's very, very important to check out their pipeline, just so that way you're aware as to what drugs it's going out of patent and what drugs are actually coming into patent. So we got the company here, Eli Lilly, non-GAAP EPS of $3.92, beats by a whopping $1.16, revenue of $11.3 billion, beats by another $1.33 billion. This beat, guys, it is up 36% year over year on revenue. Revenue in Q2 2024 increased 33%, driven by Mounjaro, Zepbound, and Verzenio. Don't know what that is. I'm guessing those drugs. When excluding the $579 million of revenue from sales from the rights of Baqsimi, don't know what that is either. Probably another drug. In Q2 of 2023, revenue in Q2 of 2024 increased 46%, excluding the sale of rights for Baqsimi. Non-incretin revenue increased 17% worldwide and 25% in the US. Fiscal 2024 consensus of $42.9 billion, EPS consensus of $13.71. The following table summarizes the company's 2024 financial guidance. We can see here that the financial guidance, at least when it comes to the revenue, has been updated, going from the low, at least for the revenue, going from the low of 42.4 to now 45.4, and the high of 43.6 now 46.6. And when it comes to, let's see over here, when it comes to the shares, before it was $13.05 to now it's $15.10 on the low end, and on the high end it is $13.55, or was, and now is $15.60. So that's really awesome. And then for the GAAP, or for the non-GAAP, that was on the GAAP version. Non-GAAP, it is $13.50, was, and now it has been updated to $16.10. And on the peak, it was $14, and now it's $16.60. We have other things here as well, like for example, let's see over here. Let's see, the reported gross margin 32 to 34% is now 36 to 38%, and on a GAAP basis, and on a non-GAAP 33 to 35, and now it is 37 to 39%. Guys, I'm going to have the link to the actual earnings report in the description below for you guys to read for yourselves, because again, I'm not going to go over it, but I think this pretty much summarizes it pretty well. Please read the earnings report if you are willing or wanting to buy into this company, because again, this is not financial advice, and every investment is the present value of all future cash flow. So with that, let's actually jump into now the calculator. We got the ticker for LLY, market cap of $803.4 billion, a PE of 124.42. Guys, this share price, I was not believing this when I first saw this. $845.31. Yeah, this is for real. This is seriously for real. On the 1 year, this is up 62.06. Year to date, 45.01. 52-week low of $516.57, and a high of nearly $1,966. Just today, this thing gained 9.5%, and post-market, a little bit less than 0.5%. Coming back over here, we can see that they do pay out a dividend of $5.20, which is, guys, a yield of, it's a tiny yield, 0.67%. Here's the thing. These payout ratios are going to look really, really bad. But this one, it is 64.42%. A 5-year CAGR of 15%, massive. But what I'm about to show you may put a damper on that. 9 consecutive years of dividend payment. Ex-dividend date is actually coming up on the 15th of August. So you guys do still have a little bit of time to buy into this company to get in with it within the ex-dividend date. Payout date will be on September 10th. And they do pay their dividends quarterly. If we come back over here with this $5.20 and their current shares outstanding, they pay out, this is a lot, $4.7 billion, guys, in dividends every single year. Take their 10-year average free cash flow. This is, by the way, where things fall apart. This is, if you take their 10-year average free cash flow, subtract that 4.7 billion, this is a negative $746 million. And the last year's free cash flow is even worse. Well, a lot worse. Negative $4 billion. Not good, guys. Yeah, these payout ratios are way over the top. So this is a little bit of an issue because now I'm like, that dividend is not safe, at least not from a cash flow perspective. But let's take a look at the graphs and see what we can learn. So now let's take a look at the fundamentals, starting with the net income 10 years ago of $2.4 billion to 1 year ago of $5.24 billion, increase of 119%. This dropped into the negative 7 years ago, but then it recovered nicely. So I'm assuming that that was just a issue, a blip. Basically, it's not really a big deal. I see it more of a big deal, though. This massive rise in the 5 years and then just slowly decreasing ever since. I guess you could say falling back into trend within the 10 to 6 years ago. But all in all, I want to give it, guys, like I want to say 70, I'm going to say a 65% just because of the decrease over here. So it's not bad, but it's just, I'm a little bit unsure to give it that 70%. Now, the free cash flow. This is the one that I am really sad to see because we got 10 years ago of 3.3 billion to 1 year ago of, 792.5 million. That is a decrease of 76% with an average of $4 billion. So as you guys can see, this is a big problem right there because that 1 year ago value is super low. Super low. In fact, the issue with this is not an increase of CapEx. I mean, it is. Don't get me wrong, it is. I mean, you got 1 billion pretty much across the board up until the 2023, which went from 1.8 billion to now 3.45 billion dollars. And the bigger issue, the cash from operations decreased from 7.6 to 4.24. That's a big problem. So I look at this and I'm like, that's not good. I'm gonna have to give this guy's like a 20% when it comes to that's really not good. Now, looking at the revenue is looking very solid. 10 years ago of 19.62 billion to 1 year ago of 34.12 billion, increase of almost 74%. Very consistently increasing. I'm gonna have to give this guy's like a 95%. Looking really good. Here are the assets as a reference only. So as the liabilities. Now, the assets minus the liabilities, though, it is decreasing. But you can see that from 5 years ago, they are basically, this is basically split down the middle, right? Decreasing from 10 to 6 and then increasing from 5 to today. So that in itself gives me a pause. Average total assets of 46.5 billion, liabilities of 35.7, a difference of $10.8 billion. I'm going to have to give this guys a 50%. I don't know where this is going, right? I don't know where this is going. This graph is literally split down the middle with good and bad, so 50%. Now, the cash flow minus the liabilities, not really surprising that the 1 year ago value is negative 52.35 billion. The average being negative 30.25 billion. Very consistently around like the negative 34 billion dollars from 7 years ago to 2 years ago. But recently they dropped that, and that was mainly due to the cash flow dropping. All in all, I'm gonna have to give this guys like a 40%. Looking now into the shares outstanding, they are buying back shares, going from 1.1 billion shares to now 900.4 million shares with an M, a decrease of 15.1%. Now, they don't consistently buy back, or at least, do they consistently? Oh, yeah. So you guys can see here, though, from 1 year ago to today, they basically issued a little bit of shares. But honestly, it's not even too bad. I'm going to have to give this guys a 100%. It's a really good looking graph. Now, lastly, cash equivalents, they currently hold $2.5 billion with an average of $3.9 billion. Overall grade, 61%. Biggest concern here is that free cash flow, right? Why that massive drop in their cash from operations? 61% is a proceed with caution kind of company because I just don't know, right? I just do not know. So are you guys invested into this? And if you are, do you know why their cash from operations dropped so dramatically last year? Let me know in the comment section below. Now with that, let's see what the discounted free cash flow says in regards to what price we should pay for this. So now if we take a look at the discounted free cash flow, these numbers look kind of crazy. So we got $222.84 not adjusting for debt and $200 essentially on the dot when it comes to adjusting for debt. Yeah, the current share price, guys, as you guys can see, is $8.45. So let's input some numbers here. When it comes to the projected share buyback, they've been buying back at around a little bit more than 1.75% every single year for the past 10 years. So let's say 1 1.5, right? 1.5 and 2% for the next 10 years. Now, when it comes to the revenue, they've been doing around 7.2% every single year for the past 10 years. Let's say 6, 7, 8, right? 6, 7, and then 8%. And all right, this gives us, guys, we're still not there. And unfortunately, this is going to get a lot cheaper or a lot lower, because recovery of the return, matching the market, I'm going to say, well, slightly beating the market. Let's just say 12%. Not there. 12%. Just because if I'm going to invest in something for 10 years, I want to at least slightly beat the S&P 500. $109.10 to $139.63, and then adjusting for debt, $83.88 to $111.72. Margin of safety of 5, 10, 15, $71.30 to $106.14. So it's looking expensive. We kind of saw that with the PE. It's looking very, very expensive. But again, it says expensive based off of these numbers right here, right? Based off of my assumptions. Every investment is the present value of all future cash flow. Please do not think that just because these numbers are saying this, the stock is going to fall to this. It's not. What this is telling you is the value of the company, right? What the company should be valued at. That's essentially what it's telling us. Not that the stock price is going there, but the value of the company should be there. I look at this and I am like, yeah, it's very, very massively expensive. I mean, you could have seen that even with the PE. Their cash flow isn't there, or at least their cash flow rise isn't there for me to justify $845. But let me know in the comment section what you guys think. Again, not financial advice. Every investment is the present value of all future cash flow. And now if we take a look at the dividend, we can see that inputting $6,215. It's a tiny yield. This nets you only $38.23. And again, with that kind of, with this right here, I'm very scared to see what happens. They may end up cutting it if that cash flow does not go up. So all in all, guys, when it comes to Eli Lilly, honestly, I can't justify the current valuation. And honestly, the fundamentals, I was expecting it to be a whole lot better. I really was. So let me know what you guys think in the comment section below. Do you own the company? Why do you like it? Do you know why the cash flow is the way that it is? What happened with them 1 year ago when it came to the cash flow? So let me know in the comment section below. But thank you so much for watching. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on Next Up Fatal Investing. And if you'd like to join us on the Discord, the link is in the description below. So with that said, peace out, and we'll see you all next time.